Good evening and welcome to another episode of Poor vs. Standard. Poor here and welcome in. As always, we are not financial advisors, so anything contained within the podcast and or YouTube videos are opinions and they are for entertainment purposes only. Please don't sue us. If you get any value through these and you enjoy what you're listening to or watching, please feel free to subscribe, join our Patreon, or shoot us an email with any questions you may have. All of these links can be found in the description boxes of the episode. Also, feel free to check us out on Twitter at @VS_poor. With that out of the way, let's get into it, shall we? So I apologize. This is coming out late on a Monday after the markets opened for the day. We are currently closed. It's about 10 o'clock at night, Eastern time. And let's just talk about some of the things that happened today. So, with the portfolio, as you can see, we're up about $900 on the course of the day. Not bad. Portfolio is getting back to those all-time high numbers, which is good, especially seeing as we added another $10,000. So, really, we're still $10,000 below where we were, before everything shit the bed. But we're getting back. There were some very large things that moved today. As you can see, I did get rid of a lot of my margin debt. I went from almost $10,000 to about half of that. We did have Torch in the portfolio, TRCH, and we sold off before the dividend just for safety. I bought in at around $3 a share, and I sold out at a little over $9 a share. And I mean, a double up for that, not a problem. And I didn't have to fight the riffraff to sell before it hits the bottom after the special dividend is announced. So that's nice. I also saw there was a CNBC article about how Torch is moving up because the oil and energy sectors were moving up, and I don't know if CNBC didn't do their homework or what and didn't realize that there was a special dividend that you have to have, bought these shares and have them in your account. Tomorrow's the last day you can buy them before, because of the T+2 rule, in order to get the dividend, the special dividend. They just didn't do their homework or what, because that article was written by a moron. So just be careful with the things you read, even from CNBC apparently, and places like that. They're not always the brightest bulb in the box. And, I'm not saying that I don't get things wrong, and I mean, we did just cover margin, and I wanted to explain one of the things that I did screw up on is that when you sell things to cover your margin costs, it doesn't affect the direct value of your account, unless you're getting a call, but that's still neither here nor there, and not the entire purpose of this episode. But that was one of the things we did to reduce our margin. The other thing is we sold half of our CTXR at around $4.20. I still like CTXR. It is getting pretty pricey at the $4.30. I don't know that I would buy anymore at these prices. But I do like having a piece of the pie. That and cents I like having. Just because when they hit, they should hit big. But I mean, we bought CTXR at under $2, so a double up, sell half your position to cover your original investment. I don't see that as a bad thing. That's the more safe and secure strategy kind of thing that we do. So AMC took a little bit of a dive. It was at 62 at the highs. Now it's at 55, 62. And I just want you folks to know that I'm not holding AMC because I hope to get rich off it. I just, I want to be in solidarity with the people who are trying to get the financial system back on the right track. There's a lot of hinky things that go on behind the scenes in financial systems and governments that benefit very few people. So this movement that has been happening is kind of about that, and it gets a lot of bad publicity because apparently hedge funds own half of all media outlets, so that's something. But it's an interesting kind of case study of something that's that's happening that hasn't really happened before in the financial industries. Like, not well. Like, there have been like coups of governments where like a socialist dictator will supplant a some other form of government, and dictators throw dictators, and it throws everything into chaos. And this is not that. It's different, and it's interesting to me because this is the sector that I've chosen to enjoy doing things with. So I monitor it closely. I watch. I see the GameStop stuff. I see the AMC stuff, the Clove stuff, and it's very interesting. And I watch, Reddit for all sorts of stuff there, and I like what's happening. I know that there's a lot of toxicity in that area, between people calling each other bots, and some of them may really be bots, and just like, no, you're taking away from this stock, or you're taking away from this stock. The movement is about this. Like, some of these people don't ascribe to the fact that like a rising tide raises all ships, kind of thing. So I don't know, but it's interesting, and I like to keep tabs on it. So I also like to show my support with my 20 shares. So yeah. And other news, I think our biggest loser was Clove. Yeah, Clove was our biggest loser. There were some option plays that lost some money for us today, but overall, CTXR was a big winner for us. It's currently at 430, as was Torch. Torch I sold for a chunk of change. I mean, we made over $1,000 on that today alone, so not bad. But that's the update on the portfolio, and I kind of wanted to cover something else with you folks tonight. I wanted to start doing a refresher on options, because we're actually approaching a year here. In another couple episodes, we will have been doing this for a year with you folks. So I just wanted to... there's not a whole lot that will fundamentally change with how options are done right now as compared to a year ago. But I just wanted to do a quick refresher for, those of you who've been listening and, forget things, or for people who haven't listened since the beginning and didn't listen to the first episodes, or want, a brief little intro. So let's do that. So just a reminder, let's see here. So this is Tesla. If you take a look, you can see Tesla options chain, and we can do this on Robinhood too, and maybe we will. We'll say, since we'll do this for the July contracts, so this has some time before it looks stupid. All right, so this is Thinkorswim, and on this side you're going to find your calls on this side of the line. See the strikes? This is the price at which you're offering to either buy or sell shares. So 595 all the way up through 650 are currently displayed, and this side's going to be the puts. All right, and if you want to buy it outright, this is the price that people are asking. If you want to sell it, this is the price that people are trying to buy it at. So if you look close to the money, it's $6 or $620 in order to buy one. People want $30.95 multiplied by 100 for an options contract would give you $3,095. If you had one and you wanted to sell it, you would collect a $3,020 premium, or you could put it somewhere in the middle there. You can name your own price with options. You are not locked into these bid-ask spreads, so that's something. So the basic one we're going to start with this time around is just the basic call. So if you wanted to buy a call, you click there, and then you can click. You'll see here in total the 65 cents for buying the contract, $3,060.65, and that'll explain to you how much buying power you're winning, making or losing, yada yada. And down here you can actually see what will happen. Like, so this is a chart of where you're profitable versus not profitable. So this is where the strike price is right here, this green line, and you'll see as you go up you get less red, so the further up the price goes. And right here where it crosses over is your break-even point, so right around 650, 65, right? Yeah, 650 is your break-even because of what you're spending. And then everything else from there, the higher the price goes, the more money you make. So you can see if the price went to 700 over here, you'd be in the money by about $5,000. Not bad, right? Not bad at all. And so on and so forth. And that's your basic call. That's a refresher for you. So as you can see, we're in the Tesla. We're in the June 25th options. So on Robinhood, it's a lot, simpler for some people, but we go to the July 16th calls. And as you can see, 620 to buy one, it would be 30.58. Sell is the same thing here. They do some weird stuff here, but you can see that their ask is 30.95. Their bid's 30.20, which if you look over here, the options chain, no, this is not even the right stock. Let's go back to Tesla. So the options chain, 30.95 and 30.20, so that matches up. And I didn't cover this because there was an editing snafu, but this is what you'll get to when you hit the review, along with some personal information which I had to edit out. So as you can see on Thinkorswim, you're buying a call. You're buying one call. It will have 10 when you first click it, but just delete the 0, you'll get to 1. It's 25 days out. The call strike price is 620. Your bid ask, you can adjust here or on the slide if you wish. Right into the middle, we put 360. And then when you click review, it'll tell you how much it'll cost you in total, which we went over. And then this will also pop up along with the stock prices that have been there in the however long you want that to go out. So that's basically it for the Thinkorswim, and then we go back over to Robinhood, and you can see right here, if you click this, they'll give you something similar. So this is basically your strike price, and as you go higher, it will calculate how much your loss is and how much your gain is, up to unlimited, because they're Robinhood. They're not the best, but they have been getting better, though their customer service is completely and utterly useless. So that's just my 2 cents and a lot of other people's. So you can do that, and you can get really crazy and do other option things, and it's have fun with the player, and it'll show you how to do those too. So that's all I wanted to show you for that part. So with that, let's get back to it. Hope you learned something. And yeah, as far as the things we were going to do with the swinging for the fences play, I was thinking maybe we look into something on this clean. I did buy one. It was a little more than $100. I did post it to our Patreon, and I will be posting it to the Twitter after this episode drops. But yes, this is one we bought. We bought it for $215. And it is in August 20th. So we got 60 days till expiration. It's $11 call. Price is currently $11.24. It's down about 5% today. We'll see where it goes. So we have till August. We have all summer. So we'll see. All right. So that's the swinging for the fences play. And man, I apologize that I didn't get this episode out earlier. It was Father's Day, so I spent some time with my dad and my family. We had a delightful bourbon drinking well, not drinking, a bourbon sampling, as it were, of different bourbons. And the winners were Rabbit Hole, and then there was also Woodford Reserve Double Oaked. So if you're a bourbon fan, those are the two that I'm highly suggesting from the multitude of them that I tried. And yeah, not really financially related, but still it was fun. So just always make sure that in the financial world, you leave this stuff at the office. You're not bringing this home. Like, this is fun. This is, retail investing stuff, but make sure that it doesn't encompass your entire life. Make sure that you have friends and family around and you enjoy them as well, because at the end of the day, people never on their deathbed say that, man, I wish I'd bought more calls. They say, man, I wish I'd spent more time with my family while they were around. So that got a little deep real quick. But yeah, so just make sure to take everything in moderation, and put in the work, do the trades, take a look at the companies you're investing in, and you'll be fine. So as always, trade well, be smart, stay safe. Good night.